As we've been reporting, President Obama and Republicans in Congress were able to cut a deal here. Republicans got tax breaks for higher earners extended for 2 more years. The president gets more jobless benefits for these long-term unemployed. The question: was the deal a good one for the overall economy? Joining us now is Dartmouth economist David Blanchflower, who was formerly a member of the Bank of England's Monetary Policy Committee. He joins us from what should be warm Fort Lauderdale, Florida, but I hear it's quite chilly down there right now.
Yeah, 46 degrees outside. It's cold.
well, there's supposed to be a snowbird. But anyhow, I wanted to talk to you, David, because what do you think that Ben Bernanke is thinking this morning? Is he happy with the compromise that President Obama is presenting?
Well, I don't necessarily know whether he's happy. I think it gives him a little bit of leeway. It means that he isn't the only show in town. The Fed has actually been the only place, if you like, to keep stimulus going, and it's looked as if the Congress and has been in gridlock. This looks like a good deal. Obviously, details yet to be worked out, but first thing is you're not going to remove those Bush tax cuts, which effectively will be to remove stimulus from the economy. And it looks like there's going to be a deal where you give some incentives for jobs. You give payroll tax cuts, which I've been advocating for a long time. So I think this is a good move. I mean, maybe you'd like to see more, but actually you get some sensible stimulus, you get compromise on the Hill, and you get relief for Bernanke. Probably means that he doesn't have to right now go to doing more QE, but this is good for the U.S. economy and certainly good for Ben Bernanke, I would say. And it's consistent with the position that he's taken. The economy needs more stimulus.
Well, you think this takes the onus off of him and puts us on Congress here to provide stimulus? I mean, how much of a change should there be to corporate America? I mean, we've had a parade of CEOs on this show and others saying, we have no visibility into 2011. What changes now? Do we see businesses spend?
Well, obviously, we've got high levels of unemployment. It's really, in a sense, we're trying to kickstart the economy. There are really good positive signs, and you want to encourage them. And essentially, economic policy has to be driven by events, has to be driven by outcomes. The big worry still is what happens to the world economy. And we're sitting here and we're going to talk in a little while about what's happening in Ireland. That sovereign debt crisis is still continuing. So in a sense, you have to protect yourself. You have to make sure, priority number one, try and get unemployment down and try at least and do some deals. And I think this is good. Bernanke, I think he'll feel relieved, probably not happy, because how can you be happy with unemployment rates this high? But I think you feel relieved this morning that at long last something's being done on the fiscal side. I think this is good for everybody. Well done, the Republicans and the president.
David, Brian Lenihan, when he spoke to us then, and certainly when you read the press now, they feel fairly confident that they have the support in Parliament to get these austerity measures passed. Does it matter, given that we know elections are going to be happening in 2011?
Well, it matters, I suspect, a little. Interesting this week, the Financial Times voted Brian Lenihan the worst finance minister in the EU. I think going forward, it's a little bit like the Treaty of Versailles. The Germans had no alternative but to sign up for it. But Keynes said down the road it's impossible to implement. And I think that's going to be the problem. The assumption in all the measures that are coming forward is that you can put more debt on a heavily indebted country. What you're going to do won't compromise growth, and all's going to be well going forward. And the bond vigilantes don't seem to believe that. I don't believe that. And we're going to see another election coming. So I think this is just the first act of many. And unfortunately, I think Germany sort of washed its hands, talked about haircuts for debt holders. What it's done is it's just the first act in Ireland, which has made further acts in Portugal and Spain and Italy almost inevitable. And on the same day, we're seeing Greece struggling to fulfill the terms of its deal. So this just looks like the first play, but I don't think down the road where that's going to be the end of it. Elections coming. This just doesn't look good. Yeah,
austerity is necessary for the Irish to receive the bailout funds. So, doesn't that do something to make you a little bit more optimistic about the compliance?
Well, it makes, fine, they're going to try and comply as the Germans tried to comply after Versailles. But if you make the terms almost impossible. You put more debt on a heavily indebted country, and you expect them to pay this high interest rate, and you don't think it's going to compromise growth. And you have to not only persuade the market, the Irish people, you have to persuade the markets as well. And I just don't think that, just look at what's happening in the markets. Nobody seems to be persuaded by this. I'm certainly not. And I think the role of the European Union, the role of the ECB, the role of the sense of the Germans is to calm nerves, and they have done exactly the opposite.
Well, politically, it's fairly dodgy to be able to do that. But talk to me on a global basis. In the break, we were just chatting about the irony that, the Irish are looking to immediately cut 6 billion euros here, and in the U.S., a deficit commission proposal can't really get going, and we're talking about adding, a week later, $900 billion to the short-term deficit.
Right. Well, I think the meeting of the G20, I think was it in 2009, was really about the consensus of trying to put stimulus together. Now what we've seen is a breakdown in Ireland, sort of forced to it by the bond markets. The UK's doing it, not forced by anybody, just by political belief. And talking there about trying to pay off the deficit in a parliament, which is about 5 years. And Bernanke this week talked about, yes, you need to pay off the deficit, but in 15 years we need to do that. So it's not just about dealing with the deficit, it's about what time period you deal with it over. And in this situation with growth compromised, it just doesn't look feasible that these little countries can pay the money off that fast. And so you have this two sets of experiments. On the same day the US is cutting taxes, and in Ireland and the UK and Greece they're raising taxes. And we're going to see which one's going to work. And my bet's that cutting taxes is better than raising taxes.
Well, I guess it's good for those who are in the book writing business here. I want to play a soundbite for you from a former Treasury Secretary in this country, Paul O'Neill, who was making the argument to me that perhaps Greece should have been allowed to fail. Listen in.
I think I proved in the case of Argentina in 2002 that it was possible and appropriate for a country that followed bad practices to go into default and basically tell their bondholders, I can't pay the interest and we're never going to pay the principal back, and for the world to say, well, that doesn't affect Brazil or Portugal.
So now that we're looking beyond the periphery, should we reconsider? Should we listen to O'Neill?
Well, I think O'Neill really does have a point. It certainly looks, if you look at the Greece example, that example is certainly not over. The Greece is today talking about, can we have more time to pay this thing off? I mean, I suspect you and I will be on this program together talking about, in some time to come, talking about at the very least restructuring the debt somehow. Maybe in the end default, but what we've got is at least that's a definitive answer. You deal with the problem and then you move forward. This is just drip, 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 do nothing, drip, wait and see what happens and wait to create a crisis. And in a sense, the bond markets are sort of saying, well, if we can create a crisis, they'll actually do something. So I just think it's a classic example of the ECB not being able to act fast enough, not really having a plan, being an institution set up to deal with things that happened in the past. And I think O'Neill has a point. It may well have been better to do that, but we may well end up there because I think we'll be seeing restructuring of the Irish and the Greek debt. What happens when you get to Ireland and Spain? That's the big problem. Sorry, to Italy and Spain. I mean, these countries are 10 times bigger than little Ireland. And so I think O'Neill may be right. If you'd have done that, then at least you'd have had a plan, you'd have dealt with it, and it may well have protected Italy and Spain. But I just think this is just a crisis, a continuing crisis with worse days to come. And the Germans, in a sense, have said, we're benefiting fine. We're not going to have a euro area bond. We're doing just fine with this nice low exchange rate.
Well, we'll see how long
the Germans are going to have to do something.
Can sing that song. So high marks from Professor Blanchflower on Bernanke's prospects, not so much for Trichet.